Welcome back, everyone. Today, we're breaking down the hottest global sectors for investment in the USA, China, Russia, and the EU. We'll also dig into the numbers from their purchasing managers' indexes, PMI, and sentiment indicators to see what they're telling us about the economy. And of course, we'll talk about how the upcoming US elections could shake things up. Let's dive in. USA. The tech and energy powerhouse remains strong, but the manufacturing PMI has been contracting for 6 straight months at 47.2 in September 2024, indicating weak demand and slower production. But don't let that scare you away. There are still key sectors ripe for investment. Even with the general slowdown, tech remains a resilient sector. Companies are still innovating in AI, cloud computing, and advanced software. With bipartisan support for green energy, the clean energy sector is seeing steady investment, especially as the U.S. pushes for sustainability. When the PMI shows contraction, it means companies are cautious. The backlog of orders is shrinking, and new orders are slower. So stick with sectors like healthcare and energy, where demand stays strong regardless of economic shifts. In China, manufacturing slows, innovation grows. China's manufacturing sector isn't looking so hot right now. In August, the manufacturing PMI fell to 49.1%, below the critical 50% mark, meaning the sector is contracting. What's causing the slowdown? Well, new orders are down, raw material inventories are shrinking, and delivery times are lengthening. But there's a silver lining. China is betting big on solar, wind, and electric vehicles, EVs. The government's focus on green energy infrastructure means this sector is primed for growth. While traditional manufacturing might be in decline, sectors like robotics and EVs are seeing a surge in investment. When you see slowdowns in manufacturing PMIs like China's, look at where the government is putting its money. Sectors like green energy and high-tech manufacturing are safer bets for the long term. Russia has a rocky road for manufacturing, and the economic outlook is mixed. The manufacturing PMI in September dropped to 49.5, marking the first contraction in over 2 years. This was driven by falling new orders and employment, with output shrinking for the first time since 2022. Despite this, Russia remains a dominant player in the global energy market, and oil and gas are still big investment areas. Metals and minerals are essential globally, so commodities continue to attract investors looking for long-term gains. A falling PMI suggests that the manufacturing sector is losing steam, but in resource-rich economies like Russia, natural resources and commodities often cushion the blow. This is why these sectors continue to be investment-worthy, even in tough times. In the European economies, manufacturing and sentiment is showing signs of instability. The EU Economic Sentiment Indicator, ES, fell recently, reflecting declining confidence across several sectors, from industry to services. Manufacturing PMI figures from various EU countries also show signs of strain, with deliveries slowing and new orders contracting. Despite the downtrend in general manufacturing, the EU is betting big on digital transformation. Fintech, cybersecurity, and e-commerce are key sectors growing due to policy support. Like the US, the EU is doubling down on green energy, and investment in solar and wind power remains a priority. Pro tip: when sentiment indicators like the ESI drop, consumer and business confidence wanes, which could mean slower growth in the short term. That's why it's important to focus on sectors where government policies, such as the Green Deal, ensure sustained investment. Finally, I would like to talk about how U.S. elections will impact these economies. If we see a major political shift, we could expect changes in trade policies, which might affect China's manufacturing exports and Russia's energy partnerships. A pro-business administration could also favor sectors like technology and finance, boosting investments. Investors tend to hold back during election periods, leading to volatility in global markets. This could result in cautious spending and delayed investments, especially in sectors that are more vulnerable to policy changes. Pro tip: during uncertain times like elections, diversify. Look at sectors like healthcare and energy, which remain relatively stable. Also, follow the PMI and sentiment trends closely, as they can give clues about when and where the economy is turning. So to wrap up, the USA, China, Russia, and the EU each have their own challenges, but they also present unique opportunities for savvy investors. Whether it's clean energy, tech, or commodities, staying informed and flexible is key. And remember, the upcoming U.S. elections could swing markets in unpredictable ways, so stay nimble. Thanks for watching, and happy investing.